An Introduction to Financial Markets Board of Governors of the Federal Reserve System, the financial and economic crisis that started in 2007 tested central banks as they had not been tested for many decades. We needed to take swift and decisive action to limit the damage to the economy from the spreading distress in financial markets. Because the financial distress was so deep and pervasive, and because it took place in financial markets, whose structure had evolved dramatically, our actions also needed to be innovative if they were to have a chance of being effective. Many central banks made substantial changes to traditional policy tools as the crisis unfolded. But the epicenter of the financial shock was in U.S. mortgage markets, with severe effects on many of our financial institutions, and our financial markets had perhaps evolved more than many others. As a consequence, no central bank innovated more dramatically than the Federal Reserve. We traditionally have provided backup liquidity to sound depository institutions. But in the crisis, to support financial markets, we had to provide liquidity to non-bank financial institutions as well. Just as we were forced to adapt and innovate in meeting our liquidity provision responsibilities, we also needed to adapt and innovate in the conduct of monetary policy. Very early in the crisis, it became evident that lowering short-term policy rates alone would not be sufficient to counter the adverse shock to the U.S. economy and financial system. We needed to go further, much further, in fact, to ease financial conditions, and thus encourage spending and support employment. We took steps to reinforce public understanding of our inflation objective to prevent the development of deflationary expectations. We provided guidance on the possible future course of our policy interest rate, and we purchased large amounts of longer-term securities, and in the process created unprecedented volumes of bank reserves. Now, careful planning is underway to remove that stimulus at the appropriate time. My discussion today will focus on innovations in both our role as liquidity provider and in our monetary policy tools, their motivation, their effectiveness, and their lessons for the future. 1. The Federal Reserve's liquidity tools before the crisis. The implementation of monetary policy was fairly straightforward, and our approach minimized its footprint on financial markets. The Federal Reserve adjusted the liquidity it provided to the banking system through daily operations with a relatively small set of broker-dealers against a very narrow set of collateral, Treasury and agency securities. These transactions had the effect of changing the aggregate quantity of reserve balances that banks held at the Federal Reserve, and that liquidity was distributed by interbank funding markets through the banking system in the United States and around the world. In addition, the Federal Reserve stood ready to lend directly to commercial banks and other depository institutions at the discount window, where, at their discretion, banks could borrow overnight at an above-market rate against a broad range of collateral when they had a need for very short-term funding. Ordinarily, however, little credit was extended through the discount window. Banks were able to obtain their funding and reserves in the open market and generally turned to the window only to cover very short-term liquidity shortfalls arising from operational glitches or transitory market-wide supply shortfalls, as opposed to more fundamental funding problems. During the financial crisis, however, market participants became highly uncertain about the financial strength of their counterparties, the future value of assets, including any collateral they might be lending against, and how their own needs for capital and liquidity might evolve. They fled to the safest and most liquid assets, and as a result, interbank markets stopped functioning as an effective means to distribute liquidity, increasing the importance of direct lending through the discount window. At the same time, however, banks became extremely reluctant to borrow from the Federal Reserve for fear that their borrowing would become known and thus cast doubt on their financial condition. Importantly, the crisis also involved major disruptions of important funding markets for other institutions. Commercial paper markets no longer channeled funds to lenders or to non-financial businesses. Investment banks encountered difficulties borrowing even on a short-term and secured basis as lenders began to have doubts about some of the underlying collateral. Banks overseas could not rely on the foreign currency swap market to fund their dollar assets beyond the very shortest terms. Investors pulled out from money market mutual funds, and most securitization markets shut down. These disruptions to financing markets pose the same threats to the availability of credit to households and businesses that runs on banks created in the more bank-centric financial system of the 1800s and most of the 1900s. As a result, intermediaries unable to fund themselves were forced to sell assets, driving down prices and exacerbating the crisis. Moreover, they were unwilling to assume the risks necessary to make markets in the debt and securitization instruments that were critical channels supporting household and business borrowing. And households and businesses unable to borrow were thus unable to spend, thereby deepening the recession. These liquidity pressures were evident in nearly every major country, and every central bank had to adapt its liquidity facilities to some degree in addressing these strains. At the Federal Reserve, we had to adapt somewhat more than most, partly because the scope of our activities prior to the crisis was fairly narrow, particularly relative to the expanding scope of intermediation outside the banking sector, and partly because the effect of the crisis was heaviest on dollar funding markets. Initially, to make credit more available to banks, we reduced the spread of the discount rate over the target federal funds rate, lengthened the maximum maturity of loans to banks from overnight to 90 days, and provided discount window credit through regular auctions in an effort to overcome banks' reluctance to borrow at the window due to concerns about the stigma of borrowing from the Federal Reserve. We also lent dollars to other central banks so that they could provide dollar liquidity to banks in their jurisdictions, thus easing pressures on U.S. money markets. As the crisis intensified, however, the Federal Reserve recognized that lending to banks alone would not be sufficient to address the severe strains affecting many participants in short-term financing markets. Ultimately, the Federal Reserve responded to the crisis by creating a range of emergency liquidity facilities to meet the funding needs of key non-bank market participants, including primary securities dealers, money market mutual funds, and other users of short-term funding markets, including purchasers of securitized loans. Why couldn't the Federal Reserve maintain its routine lending practices and rely on lending to commercial banks, which in turn lend to non-bank firms? The reason is that financial markets have evolved substantially in recent decades, and, in retrospect, by more than we had recognized prior to the crisis. The task of intermediating between investors and borrowers has shifted over time from banks, which take deposits and make loans, to securities markets, where borrowers and savers meet more directly, albeit with the assistance of investment banks that help borrowers issue securities and then make markets in those securities. An important aspect of the shift has been the growth of securitization, in which loans that might in the past have remained on the books of banks are instead converted into securities and sold to investors in global capital markets. Serious deficiencies with these securitizations, the associated derivative instruments, and the structures that evolved to hold securitized debt were at the heart of the financial crisis. Among other things, the structures exposed the banking system to risks that neither participants in financial markets nor regulators fully appreciated. Banks became dependent on liquid markets to distribute the loans they had originated, and some parts of the securitized loans were sold to off-balance sheet entities in which long-term assets were funded by short-term borrowing with implicit or explicit liquidity guarantees provided by the banks. Securitization markets essentially collapsed when banks became unwilling to increase their exposure to such risks during the crisis, when the liquidity guarantees were invoked, and when other lenders in securitization markets became unwilling to supply credit. Although the Federal Reserve's lending actions during the crisis were innovative and to some degree unprecedented, they were based on sound legal and economic foundations. Our lending to non-bank institutions was grounded in clear authority found in Section 13(3) of the Federal Reserve Act, permitting a 5-member majority of the Federal Reserve Board to authorize a reserve bank to lend to individuals, partnerships, or corporations in unusual and exigent circumstances. These actions also generally adhered to Walter Bayhot's dictum, a time-honored central banking principle for countering a financial panic. Lend early and freely to solvent institutions at a penalty rate and against good collateral. Central banks are uniquely equipped to carry out this mission. They regularly lend to commercial banks against a wide variety of collateral and have the infrastructure to value and perfect their interest in the underlying collateral. During a panic, market functioning is typically severely impaired, with investors fleeing toward the safest and most liquid assets, and the resulting lack of liquidity, even for sound banks with sound assets, can result in funding pressures for financial institutions and others. By lending to solvent institutions against illiquid collateral, central banks effectively step in to assume the liquidity risk of such assets. That is, the risk that assets can only be sold in the near term at fire sale prices. And their ability to substitute for private sector intermediation in a panic is unlimited since they create reserves. For the most part, the Federal Reserve priced these facilities to be attractive when markets were disrupted, but not economical to potential borrowers as market functioning improved. Importantly, lending against good collateral to solvent institutions supplies liquidity, not capital, to the financial system. To be sure, limiting a panic mitigates the erosion of asset prices and hence capital. But central banks are not the appropriate authorities to supply capital directly. If government capital is necessary to promote financial stability, then that is a fiscal function. This division of responsibilities presented challenges in the crisis. The securitization markets were impaired by both a lack of liquid funding and by concerns about the value of the underlying loans, and broad-based concerns about the integrity of the securitization process. To restart these markets, the Federal Reserve worked with the Treasury in establishing the term Asset-Backed Securities Loan Facility, TALF. The Federal Reserve supplied the liquid funding, while the Treasury assumed the credit risk. The issue of the appropriate role of the central bank and fiscal authority was present in other contexts as well. We were well aware that we were possibly assuming a risk of loss when we lent to stabilize the systemically important firms of Bear Stearns and American International Group, AIG. Unfortunately, at the time, alternative mechanisms were not available, and we lent with the explicit support of the Secretary of the Treasury, including a letter from him acknowledging the risks. An important task before us now is to assess the effectiveness of these actions. Not surprisingly, rigorous studies that evaluate the extent to which the emergency liquidity facilities contributed to improved financial conditions are just beginning to emerge. Nonetheless, market reactions to the announcement of the emergency facilities, anecdotal evidence, and a number of the studies we do have suggested that the facilities forestalled potentially much worse outcomes and encouraged improvements. For example, some asset-backed securities, ABS, spreads, such as those for consumer ABS and commercial mortgage-backed securities, narrowed significantly following the creation of the TALF, and activity in ABS markets has picked up. While the overall improvement in the economic outlook has no doubt contributed to the improvement in ABS markets, it does appear that the TALF helped to buoy the availability of credit to firms and households and thus supported economic activity. Indeed, following the kickstart from the TALF, a number of these markets are now operating without any governmental backing. Another example is the reduction in pressures in U.S. dollar funding markets, as evidenced by the sharp narrowing of spreads between LIBOR, London Interbank Offered Rates, and OIS, Overnight Index Swap, rates, and the decline in premiums paid for U.S. dollars in foreign exchange swap markets. These developments followed the establishment of the term auction facility, which auctioned discount window credit to depository institutions, and also of liquidity swaps between the Federal Reserve and foreign central banks, which enabled those banks to lend dollars to commercial banks in their jurisdictions. Our willingness to lend in support of the commercial paper and asset-backed commercial paper markets helped to stem the runs on money market funds and other non-bank providers of short-term credit. Of note, usage of these emergency liquidity facilities declined markedly as conditions in financial markets improved, indicating that they were indeed priced at a penalty to more normal market conditions. They were successfully closed, suggesting that market participants had not become overly reliant on these programs and were able to regain access to funding markets. Except for the TALF and the special Bear Stearns and AIG loans, all were repaid without any losses to the Federal Reserve. The funding markets evidently remain somewhat vulnerable, however. Just this week, with the reemergence of strains in U.S. dollar short-term funding markets in Europe, the Federal Reserve re-established temporary U.S. dollar liquidity swap facilities with the Bank of Canada, the Bank of England, the European Central Bank, the Bank of Japan, and the Swiss National Bank. For lessons for handling future liquidity disruptions. What lessons can be drawn from the Federal Reserve's experience in the financial crisis when designing the toolbox for dealing with future systemic liquidity disruptions? First, the crisis has demonstrated that, In a financial system so dependent on securities markets and not just banks for the distribution of credit, our ability to preserve financial stability may be enhanced by making sure the Federal Reserve has authority to lend against good collateral to other classes of sound, regulated financial institutions that are central to our financial markets, not on a routine basis, but when the absence of such lending would threaten market functioning and economic stability. Thus, it would seem that authority similar to that provided by Section 13(3) will continue to be necessary. Second, we recognize that holding open this possibility is not without cost. With credit potentially available from the Federal Reserve, institutions would have insufficient incentives to manage their liquidity to protect against unusual market events. Hence, emergency credit should generally be available only to groups of institutions that are tightly regulated and closely supervised to limit the moral hazard of permitting access to the discount window, even when such access is not routinely granted. If the Federal Reserve did not directly supervise the institutions that would potentially receive emergency discount window credit, it would need an ongoing and collaborative relationship with the supervisor. The supervisor should ensure that any institution with potential access to emergency discount window credit maintained conservative liquidity policies. The supervisor would also provide critical insight into the financial condition of the borrower and the quality of the available collateral, and more generally, whether lending was necessary and appropriate. Most importantly, no such institution should be considered too big or too interconnected to fail, and any losses should be shouldered by shareholders and other providers of capital, by management, and, where consistent with financial stability, by creditors as well. Third, the United States needs a resolution facility for systemically important institutions that meets the criteria I just enunciated. That authority must have access to liquidity to stabilize situations where necessary, but the fiscal authorities, not the central bank, should be the ones deciding whether to take on the credit risk of lending to troubled institutions in order to forestall financial instability. Fourth, transparency about unusual liquidity facilities is critical. The public appropriately expects that when a central bank takes innovative actions, especially actions that might appear to involve more risk than normal lending operations, then it will receive enough information to judge whether the central bank has carried out the policy safely and fairly. The required degree of transparency might well involve more detailed types of reporting than for normal, ongoing lending facilities. Finally, the problem of discount window stigma is real and serious. The intense caution that banks displayed in managing their liquidity, beginning in early August 2007, was partly a result of their extreme reluctance to rely on standard discount mechanisms. Absent such reluctance, conditions in interbank funding markets might have been significantly less stressed, with less contagion to financial markets more generally. Central banks eventually were able to partially circumvent this stigma by designing additional lending facilities for depository institutions. But analyzing the problem, developing these programs, and gathering the evidence to support a conclusion that they were necessary took valuable time. Going forward, if measures are adopted that could further exacerbate the stigma of using central bank lending facilities, the ability of central banks to perform their traditional functions to stabilize the financial system in a panic may well be impaired. Monetary policy and the zero bound the Federal Reserve and other central banks reacted to the deepening crisis in the fall of 2008 not only by opening new emergency liquidity facilities, but also by reducing policy interest rates to close to zero and taking other steps to ease financial conditions. Such rapid and aggressive responses were expected to cushion the shock to the economy by reducing the cost of borrowing for households and businesses, thereby encouraging them to keep spending. After short-term rates reached the effective zero bound in December 2008, the Federal Reserve also acted to shape interest rate and inflation expectations through various communications. At the March 2009 meeting, the Federal Open Market Committee, FOMC, indicated that it viewed economic conditions as likely to warrant exceptionally low levels of the federal funds rate for an extended period. This language was intended to provide more guidance than usual about the likely path of interest rates and to help financial markets form more accurate expectations about policy in a highly uncertain economic and financial environment. By noting that the federal funds rate was likely to remain at exceptionally low levels for an extended period, the FOMC likely was able to keep long-term interest rates lower than would otherwise have been the case. To provide the public with more context for understanding monetary policy decisions, board members and Reserve Bank presidents agreed in late 2007 to prepare more frequent forecasts covering longer time spans and explain those forecasts. In January 2009, the policymakers also added information about their views of the long-run levels to which economic growth, inflation, and the unemployment rate were likely to converge over time. The additional clarity about the long-run level for inflation, in particular, likely helped keep inflation expectations anchored during the crisis. Had expectations followed inflation down, real interest rates would have increased, restraining spending further. Had expectations risen because of concern about the Federal Reserve's ability to unwind the unusual actions it was taking, we might have needed to limit those actions and the resulting boost to spending. Given the severity of the downturn, however, it soon became clear that lowering short-term policy rates and attempting to shape expectations would not be sufficient alone to counter the macroeconomic effects of the financial shocks. Indeed, once the Federal Reserve reduced the federal funds rate to zero, no further conventional policy easing was possible. The Federal Reserve needed to use alternative methods to ease financial conditions and encourage spending. Thus, to reduce longer-term interest rates, like those on mortgages, the Federal Reserve initiated large-scale purchases of longer-term securities, specifically Treasury securities, agency mortgage-backed securities, MBS, and agency debt. All told, the Federal Reserve purchased $300 billion of Treasury securities, about $175 billion of agency debt obligations, and $1.25 trillion of agency MBS. In the process, we ended up supplying about $1.2 trillion of reserve balances to the banking system, a huge increase from the normal level of about $15 billion over the few years just prior to the crisis. How effective had these various steps been in reducing the cost of borrowing for households and businesses while maintaining price stability? Central banks have lots of experience guiding the economy by adjusting short-term policy rates and influencing expectations about future policy rates, and the underlying theory and practice behind those actions are well understood. The reduction of the policy interest rate to close to zero led to a sharp decline in the cost of funds in money markets, especially when combined with the creation of emergency liquidity facilities and the establishment of liquidity swaps with foreign central banks that greatly narrowed spreads in short-term funding markets. Event studies at the time of the release of the March 2009 FOMC statement, when the extended period language was first introduced, indicate that the expected path of policy rates moved down substantially. Market participants reportedly interpreted the characterization of the federal funds rate as likely to remain low for an extended period, as stronger than the for some time language included in the previous Statement 5. Nonetheless, the extended period language has not prevented interest rates and market participants' expectations about the timing of exit from the zero interest rate policy from reacting to incoming economic information, though each repetition of the extended period language has appeared to affect those expectations a little. By contrast, the economic effects of purchasing large volumes of longer-term assets and the accompanying expansion of the reserve base in the banking system are much less well understood. One question involves the direct effects of the large-scale asset purchases themselves. The theory behind the Federal Reserve's actions was fairly clear. Arbitrage between short and long-term markets is not perfect even when markets are functioning smoothly, and arbitrage is especially impaired during panics when investors are putting an unusually large premium on the liquidity and safety of short-term instruments. In these circumstances, purchasing longer-term assets, and thus taking interest rate risk from the market, pushes up the prices of the securities, thereby lowering their yields. But by how much and for how long? Good studies of these sorts of actions also are sparse. Currently, we are relying in large part on event studies, analyzing how much interest rates declined when purchases were announced in the United States or abroad. According to these studies, spreads on mortgage-related assets fell sharply on November 25, 2008, when the Federal Reserve announced that it would initiate a program to purchase agency debt and agency MBS. A similar pattern for Treasury yields was observed following the release of the March 2009 FOMC statement, when purchases of longer-term Treasury securities were announced. 6. Effectiveness, however, is hard to quantify, partly because we are uncertain about how, exactly, the purchases put downward pressure on interest rates. My presumption has been that the effect comes mainly from the total amount we purchase relative to the total stock of debt outstanding. However, others have argued that the market effect derives importantly from the flow of our purchases relative to the amount of new issuance in the market. Some evidence for the primacy of the stock channel has accumulated recently, as the recent end of the MBS purchase program does not appear to have had significant adverse effects in mortgage markets. A second issue involves the effects of the large volume of reserves created as we purchased assets. The Federal Reserve has funded its securities purchases by crediting the accounts that banks hold with us. In explanations of our actions during the crisis, we have focused on the effects of our purchases on the prices of the assets that we bought and on the spillover to the prices of related assets, as I have just done. The huge quantity of bank reserves that were created has been seen largely as a byproduct of the purchases that would be unlikely to have a significant independent effect on financial markets and the economy. This view, however, is not consistent with the simple models in many textbooks or the monetarist tradition in monetary policy, which emphasizes a line of causation from reserves to the money supply to economic activity and inflation. According to these theories, extra reserves should induce banks to diversify into additional lending and purchases of securities, reducing the cost of borrowing for households and businesses, and so should spark an increase in the money supply and spending. To date, this channel does not seem to have been effective. Interest rates on bank loans relative to the usual benchmarks remain elevated. The quantity of bank loans is still falling, and money supply growth has been subdued. Banks' behavior appears more consistent with the standard Keynesian model of the liquidity trap, in which demand for reserves becomes perfectly elastic when short-term interest rates approach zero. But the portfolio behavior of banks might shift as the economy and confidence recover, and we will need to watch and study this channel carefully. Another uncertainty deserving of additional examination involves the effect of large-scale purchases of longer-term assets on inflation expectations. The more we buy, the more reserves we will ultimately need to absorb, and the more assets we will ultimately need to dispose of before the conduct of monetary policy, the behavior of interbank markets, and the Federal Reserve's balance sheet can return completely to normal. As a consequence, these types of purchases can increase inflation expectations among some observers who may see a risk that we will not reduce reserves and raise interest rates in a timely fashion. So far, longer-term inflation expectations have generally been well anchored over the past few years of unusual Federal Reserve actions. However, many unsettled issues remain regarding the linkage between central bank actions and inflation expectations, and concerns about the effect of the size of our balance sheet are often heard in financial market commentary. Lesson from conducting monetary policy in a crisis: it is certainly too soon to fully assess all the lessons learned concerning the conduct of monetary policy during the crisis. But a few observations seem worth noting even at this early stage. First, commitments to maintain interest rates at a given level must be properly conditioned on the evolution of the economy. If they are to achieve their objectives, central banks cannot make unconditional interest rate commitments based only on a time dimension. The Bank of Canada has recently illustrated that need by revising its time commitment based on changing circumstances. To further clarify that the extended period language is conditional on the evolution of the economy, the FOMC emphasized in the November 2009 statement that its expectation that the federal funds rate is likely to remain at an exceptionally low level for an extended period depended on the outlook for resource utilization, inflation, and inflation expectations following the anticipated trajectories. Second, as I previously pointed out, firmly anchored inflation expectations are essential to successful monetary policy at any time. That's why central banks have not followed the standard academic recommendation to set a higher inflation target, either temporarily or, as has been recently suggested, over the longer run, to reduce the likelihood of hitting the zero lower bound. Although I agree that hitting the zero bound presents challenges to monetary policy, I do not believe central banks should raise their inflation targets. Central banks around the world have been working for 30 years to get inflation down to levels where it can largely be ignored by businesses and households when making decisions about the future. Moreover, inflation expectations are well anchored at those low levels. Increasing our inflation targets could result in more variable inflation and worse economic outcomes over time. Inflation expectations would necessarily have to become unanchored as inflation moved up. I doubt households and businesses would immediately raise their expectations to the new targets, and that expectations would then be well anchored at the new higher levels. Instead, I fear there could be a long learning process, just as when inflation trended down over recent decades. Moreover, a higher inflation target might also mean that inflation would be higher than can be ignored, and businesses and households may take inflation more into account when writing contracts and making investments, increasing the odds that otherwise transitory inflation would become more persistent. For both these reasons, raising the longer-term objective for inflation could make expectations more sensitive to recent realized inflation, to central bank actions, and to other economic conditions. That greater sensitivity would reduce the ability of central banks to buffer the economy from bad shocks. It could also lead to more volatile inflation over the longer run and therefore higher inflation risk premiums in nominal interest rates. It is notable that while the theoretical economic arguments for raising inflation targets are well understood, no major central bank has raised its target in response to the recent financial crisis. Third, it appears that large-scale asset purchases at the zero bound do help to ease financial conditions. Our best judgment is that longer-term yields were reduced as a result of our asset purchases. The lower rates on mortgages helped households that could refinance and supported demand to help stabilize the housing market. Moreover, low rates on corporate bonds contributed to a wave of longer-term business financing that has strengthened the financial condition of firms that could access securities markets and contributed to the turnaround in business investment. Fourth, central banks also need to be mindful of the potential effects on inflation expectations of the expansion of their balance sheet. Most policymakers do not tend to put too much stock in the very simple theories relating excess reserves to money and inflation that I mentioned earlier. But we are aware that the size of our balance sheet is a potential source of policy stimulus, and we need to be alert to the risk that households, businesses, and investors could begin to expect higher inflation based partly on an expanded central bank balance sheet. As always, the Federal Reserve monitors inflation developments and inflation expectations very closely, and any signs of a significant deterioration in the inflation outlook would be a matter of concern to the FOMC. Fifth, central banks need to have the tools to reverse unusual actions, to drain reserves and raise interest rates when the time comes. Confidence in those tools should help allay any fears by the public that unusual actions will necessarily lead to inflation. And having or developing those tools is essential to allow aggressive action to ease financial conditions as the economy heads into recession. In the case of the Federal Reserve, our ability to pay interest on excess reserves, which we received only in September 2008, is a very important tool that made us more comfortable taking extraordinary steps when they were needed. It allows us to put upward pressure on short-term interest rates, even with very elevated levels of reserves. In addition, we are developing new tools, including reverse repurchase agreements and term deposits that will allow us to drain significant quantities of reserves when necessary. Finally, let me close with some comments on a lesson learned that some observers have emphasized: that long periods of low interest rates inevitably lead to financial imbalances, and that the Federal Reserve should adjust its policy setting to avoid the buildup of such imbalances. As I have indicated at other times, I don't think we know enough at this point to answer with any confidence the question of whether monetary policy should include financial stability along with price stability and high employment in its objectives. Given the bluntness of monetary policy as a tool for addressing developments that could lead to financial instability, given the side effects of using policy for this purpose, including the likely increase in variability of inflation and economic activity over the medium term, and given the need for timely policy action to realize greater benefits than costs in leaning against potential speculative excesses, my preference at this time is to use prudential regulation and supervision to strengthen the financial system and lean against developing financial imbalances. I don't minimize the difficulties of executing effective macroprudential supervision, Nor do I rule out using interest rate policy in circumstances in which dangerous imbalances are building and prudential steps seem to be delayed or ineffective. But I do think regulation can be better targeted to the developing problem, and the balance of costs and benefits from using these types of instruments are far more likely to be favorable than from using monetary policy to achieve financial stability. Conclusion: the most severe financial crisis since the Great Depression has caused suffering around the world. It also has been a difficult learning experience for central bankers. Monetary policymakers must ask whether the strategies and tools at their disposal need to be adapted to fulfill their responsibilities for price and economic stability in modern financial markets. As with the most interesting questions, the answers aren't at all clear. But we should use our experience to foster a constructive discussion of these critical questions, because addressing these issues will enable central banks to more effectively promote financial stability and reduce the odds of future crises. Different types of financial institutions in today's financial services marketplace. A financial institution exists to provide a wide variety of deposit, lending, and investment products to individuals, businesses, or both. While some financial institutions focus on providing services and accounts for the general public, others are more likely to serve only certain consumers with more specialized offerings. The types of financial institutions range from banks and credit unions to investment banks and brokerage firms to mortgage lenders. To know which financial institution is most appropriate for serving a specific need, learn about the different types of institutions and their purposes. KUETAKAWA's 8 major types of financial institutions provide various services from mortgage loans to investment vehicles. Financial institutions help regulate the economy, ensure fair financial practices, and facilitate prosperity. The major categories of financial institutions are central banks, retail and commercial banks, internet banks, credit unions, savings and loan, S&L, associations, investment banks and companies, brokerage firms, insurance companies, and mortgage companies. Within a capitalistic economic system, financial institutions help regulate the economy, ensure fair financial practices, and facilitate prosperity. There is no hard and fast list of types of financial institutions. Title 31 of the U.S. Code lists 31 types, while industry sources list a lot fewer. But for most consumers and investors, these are the most important financial institutions to know about. 1. Central banks. Central banks are the financial institutions responsible for overseeing and managing all other banks. In the United States, the central bank is the Federal Reserve Bank, Fed, which is responsible for conducting monetary policy and supervising and regulating financial institutions. One, individual consumers do not have direct contact with a central bank. Instead, large financial institutions work directly with the Fed to provide products and services to the general public. 2. Retail and commercial banks. Traditionally, retail banks offered products to individual consumers, while commercial banks work directly with businesses. Today, most large banks offer deposit accounts, loans, and limited financial advice to both consumers and businesses. Products offered at retail and commercial banks include checking and savings accounts, certificates of deposit, CDs, personal and mortgage loans, credit cards, and business banking accounts. Internet banks offer the same products and services as conventional banks, but they do so through online platforms instead of brick-and-mortar locations. Internet banks may allow consumers to carry out banking services via computer, mobile device, automated teller machine, ATM, or by calling a customer service line. Using your phone and the bank's app, you can deposit checks into your account by taking a picture of your check to 3. Credit unions. A credit union is a type of nonprofit financial institution providing traditional banking services and is created, owned, and operated by its members. Historically, credit unions used to serve a specific and shared demographic group, also known as the field of membership. The commonality might be based on employer, a geographic area, or membership in another type of group. Today, many have loosened membership restrictions and are open to the general public with minimal requirements, such as joining a nonprofit organization for a small fee. 3 credit unions are not publicly traded and only need to make enough money to continue daily operations, so they often can afford to provide reduced fees and better interest rates than banks. 3-4. Savings and loan, S&L. Associations, savings and loan associations provide individual consumers with checking accounts, personal loans, and home mortgages. Financial institutions are owned by their customers or community. A savings and loan is a type of thrift that is required by law to produce a certain number of loans secured by residential real estate. But the aim of most savings and loans is to lend for residential mortgages 45-5. Investment banks are financial institutions that provide services and act as an intermediary in complex transactions. For instance, when a startup is preparing for an initial public offering, IPO, or when one company is merging with another. They can also act as a broker or financial advisor for large institutional clients such as pension funds. Investment banks help individuals, businesses, and governments raise capital through the issuance of Securities 6.6. Brokerage firms assist individuals and institutions in buying and selling securities among available investors. Customers of brokerage firms can place trades of stocks, bonds, mutual funds, exchange-traded funds, ETFs, and some alternative investments. Insurance companies, financial institutions that help individuals transfer the risk of loss are known as insurance companies. Individuals and businesses use insurance companies to protect against financial loss due to death, disability, accidents, property damage, and other misfortunes. These companies can also include the self-insurance programs of other financial institutions, such as a savings and loan holding company 5/8. Mortgage companies, financial institutions that specialize in originating or funding mortgage loans are mortgage companies. While most mortgage companies serve the individual consumer market, some specialize in lending options for commercial real estate only. Mortgage companies focus exclusively on originating loans and seek funding from financial institutions that provide the capital for the mortgages. Many mortgage companies today operate online or have limited branch locations, which allows for lower mortgage costs and fees. What is a financial intermediary? A financial intermediary is an entity that acts as the middleman between two parties, generally banks or funds, in a financial transaction. A financial intermediary may lower the cost of doing business. How do banks make money? Banks make money by charging a variety of fees and by earning interest from loans such as mortgages, auto loans, business loans, and personal loans. The bank pays depositors interest for using money to make those loans. The bank's profit comes from difference between what the bank earns on fees and interest and what it pays depositors. Are all financial institutions safe? Yes, barring an economic catastrophe. Banks and credit unions are generally safe places to keep your money because they are insured by the federal government via two agencies: the Federal Deposit Insurance Corp, FDIC, and the National Credit Union Administration, NCUA. This insurance covers your principal and any interest you're owed through the date of your bank's default. Up to $250,000 in combined total balances, 910, are cryptocurrency exchanges considered financial institutions? It's complicated. Despite a large number of cryptocurrency investors and blockchain firms in the United States, the country hasn't yet developed a clear regulatory framework for the asset class. The Securities and Exchange Commission, SEC, typically views cryptocurrency as a security, while the Commodity Futures Trading Commission, CFTC, calls Bitcoin a commodity, and the Treasury calls it a currency. Crypto exchanges in the United States fall under the regulatory scope of the Bank Secrecy Act, BSA, and must register with the Financial Crimes Enforcement Network, FinCEN. They are also required to comply with anti-money laundering, AML, and combating the financing of terrorism, CFT, obligations. 11. The bottom line, there are 8 major types of financial institutions that provide a variety of services from mortgage loans to investment vehicles. Financial institutions are vital for regulating the economy, ensuring fair financial practices, and facilitating prosperity. The major categories of financial institutions are central banks, retail and commercial banks, credit unions, savings and loan associations, investment banks and companies, brokerage firms, insurance companies, and mortgage companies. Types of financial markets. Financial markets are of many types, including general and specialized, capital and money, and primary and secondary. Key points: a financial market is an aggregate of possible buyers and sellers of financial securities, commodities, and other fungible items, as well as the transactions between them. The term financial markets is often used to refer solely to the markets that are used to raise finance. For long-term finance, capital markets are used. For short-term finance, maturity up to 1 year, money markets are used. Stock markets and bond markets are two types of capital markets that provide financing through the issuing of shares of stock or the issuing of bonds, respectively. A key division within the capital markets is between the primary markets and secondary markets. While capital markets and money markets constitute the narrower definition of financial markets, other markets, such as derivatives and currency markets, are often included in the more general sense of the word. Key terms: derivative, a financial instrument whose value depends on the valuation of an underlying asset, such as a warrant, an option, etc. Maturity, date when payment is due. Capital, money and wealth, the means to acquire goods and services, especially in a non-barter system. Fungible, able to be substituted for something of equal value or utility. Interchangeable, exchangeable, replaceable. A financial market is an aggregate of possible buyers and sellers of financial securities, commodities, and other fungible items, as well as the transactions between them. Examples of financial markets include capital markets, derivative markets, money markets, and currency markets. There are many different ways to divide and classify financial markets. For example, into general markets and specialized markets, capital markets and money markets, and primary and secondary markets. Within the financial sector, the term financial markets is often used to refer solely to the markets that are used to raise finance. For long-term finance, capital markets are used. For short-term finance, maturity up to 1 year, money markets are used. Stock markets and bond markets are two types of capital markets that provide financing through the issuing of shares of stock and the issuing of bonds, respectively. A key division within the capital markets is between the primary markets and secondary markets. Newly formed, issued. Securities are bought or sold in primary markets, such as during initial public offerings. Secondary markets are for the secondary trade of securities, providing a continuous and regular market for the buying and selling of securities. While capital markets and money markets constitute the narrower definition of financial markets, other markets are often included in the more general sense of the word. The derivatives market is the financial market for derivatives financial instruments like futures contracts or options, which are derived from other forms of assets. Currency markets, enabled by foreign exchange or forex. Markets enable currency conversion and determine the relative value of world currencies. Defining the role of financial markets, one of the main functions of financial markets is to allocate capital, matching those who have capital to those who need it. Key points: one of the main functions of financial markets is to allocate capital. Capital markets especially facilitate the raising of capital, while money markets facilitate the transfer of liquidity, in both cases matching those who have capital to those who need it. Financial markets attract funds from investors and channel them to enterprises that use that capital to finance their operations and achieve growth, from startup phases to expansion, even much later in the firm's life. Without financial markets, borrowers would have difficulty finding lenders themselves. Intermediaries such as banks help in this process. Bank deposits are a simple way in which capital is allocated from a pool of savers to businesses that want to deploy it. More complex transactions than a simple bank deposit require markets, where lenders and their agents can meet borrowers and their agents, and where existing instruments can be resold. One example being the stock exchange. Key terms: exchange, a place for conducting trading. Capital, money and wealth, the means to acquire goods and services, especially in a non-barter system. Liquidity, availability of cash over short term. Ability to service short-term debt. Financial market: a financial market is an aggregate of possible buyers and sellers of financial securities, commodities, and other fungible items and the transactions between them. Within the financial sector, the term financial markets is often used to refer just to the markets that are used to raise finance. The capital markets for long-term finance and the money markets for short-term finance, maturity up to 1 year. Allocating capital: one of the main functions of financial markets is to allocate capital. Capital markets especially facilitate the raising of capital, while money markets facilitate the transfer of liquidity, matching those who have capital to those who need it. Financial markets attract funds from investors and channel them to enterprises that use that capital to finance their operations and achieve growth, from startup phases to expansion, even much later in the firm's life. Money markets allow firms to borrow funds on a short-term basis, while capital markets allow corporations to gain long-term funding to support expansion. Funds borrowed from the money markets are typically used for general operating expenses, to cover brief periods of illiquidity. When a company borrows from the primary capital markets, often the purpose is to invest in additional physical capital goods, which will be used to help increase its income. Financial capital is money used by entrepreneurs and businesses to buy what they need to make their products or provide their services. It can take many months or years before the investment generates sufficient return to pay back its cost, and hence the finance is long-term. Long-term capital can come in the form of shared capital, mortgage loans, and venture capital, among other types. Without financial markets, borrowers would have difficulty finding lenders themselves. Intermediaries such as banks help in this process. Banks take deposits from those who have money to save. Individuals may not be aware that they are acting as lenders, providing capital. But many people do lend money at least indirectly. For example, when they deposit money in a savings account or contribute to a pension. Intermediaries like banks can then lend money from this pool of deposits to those who seek to borrow in the form of loans. More complex transactions than a simple bank deposit require markets, where lenders and their agents can meet borrowers and their agents, and where existing borrowing or lending commitments can be sold on to other parties. One example is the stock exchange, where a company can raise money by selling ownership shares to investors and its existing shares can be bought or sold. Defining financial markets can provide feedback to management by showing signals of the demand to supply funds to that enterprise. Key points: financial markets function through the interaction of buyers and sellers that determine the price of traded assets. Financial markets provide a sign for the allocation of funds in the economy based on the demand and supply through the mechanism called the price discovery process. Management often has imperfect information about its own business. One way in which managers try to gain feedback on their business is by conducting market research. Financial markets can also provide feedback. These various audiences can provide feedback to management, such as when the stock price rises or declines. However, given that the stock market is prone to oscillation, this feedback can vary in its usefulness for managers making decisions. More complex transactions than a simple bank deposit require markets, where lenders and their agents can meet borrowers and their agents, and where existing instruments can be resold, an example being the stock exchange. Key terms: feedback, critical assessment on information produced. Market role in providing feedback to management often has imperfect information about its own business, especially its business's value in the outside world. One way in which managers try to gain feedback on their business is by conducting market research to discover what people want, need, or believe. Once that research is completed, it can be used to determine how to market various products. Financial markets can also provide feedback, demonstrating how potential shareholders view the financial value of one company as compared to its competitors. For example, investors who hold shares in multiple firms in a sector may have more information about the prospects in that sector than the manager of only one firm in that sector. In economics and contract theory, information asymmetry deals with the study of decisions in transactions where one party has more or better information than the other, creating an imbalance of power. Financial economists have applied information asymmetry in studies of differentially informed financial market participants, insiders, stock analysts, investors, among others. These various audiences can provide feedback to management, such as when the stock price rises or declines. That said, the stock market is an example of a system prone to oscillation. It is governed by positive and negative feedback resulting from the cognitive and emotional factors among market participants. This may be the result of data-based fundamental analysis or more sentiment-based analysis, meaning that the feedback from the stock market can vary in its usefulness for managers making short-term and long-term decisions. Defining the Securities Act of 1933, the Securities Act of 1933 ensures investors receive complete and accurate information before they invest. Key points: the Act's objectives are to provide investors with material financial and other corporate information about issuers of public securities. The primary purpose of the 1933 Act is to ensure that buyers of securities receive complete and accurate information before they invest. Among other things, registration forms call for a description of the securities to be offered for sale, information about the management of the issuer, information about the securities, if other than common stock, and financial statements certified by independent accountants. Rule 144, promulgated by the SEC under the 1933 Act, permits, under limited circumstances, the sale of restricted and controlled securities without registration. Regulation S is a safe harbor that defines when an offering of securities is deemed to be executed in another country and therefore not be subject to the registration requirement under Section 5 of the 1933 Act. Key terms: private placements. Private placement, or non-public offering, is a funding round of securities which are sold not through a public offering, but rather through a private offering, mostly to a small number of chosen investors. SEC. The U.S. Securities and Exchange Commission, frequently abbreviated SEC, is a federal agency which holds primary responsibility for enforcing the federal securities laws and regulating the securities industry, the nation's stock and options exchanges, and other electronic securities markets in the United States. The Securities Act of 1933. The Securities Act of 1933, also known as the 33 Act, is essentially a consumer protection law for retail investors, not money managers, foundations, pensions, etc. The Act's objectives are to provide investors with material, financial, and other corporate information about issuers of public securities, stocks and bonds, and to prevent fraud in the offering of such securities. The primary purpose of the 33 Act is to ensure that buyers of securities receive complete and accurate information before they invest. Registration process unless they qualify for an exemption. Securities offered or sold to the public in the U.S. must be registered by filing a registration statement with the SEC. Although the law is written to require registration of securities, as a practical matter it is more useful to consider the requirement to be that of registering offers and sales. If person A registers a sale of securities to person B, and then person B seeks to resell those securities, person B must still either file a registration statement or find an available exemption. Many transactions are exempt from regulation under the Securities Act. Section 4 of the Act limits its application to public offerings, according to SEC guidelines, more than 25 offerees, by issuers and their underwriters, investment banks. This means that the Act primarily applies to companies offering securities to the public, and not to transactions between investors or to sales of stock to small groups of investors, private placements. The prospectus, which is the document through which an issuer's securities are marketed to a potential investor, is included as part of the registration statement. The SEC prescribes the relevant forms on which an issuer's securities must be registered. Among other things, registration forms call for a description of the securities to be offered for sale, information about the management of the issuer, information about the securities, if other than common stock, financial statements certified by independent accountants for public offerings. The main requirement of the Securities Act is registration. An issuer must prepare an extensive statement describing the securities to be offered and detailing the nature of the issuer's business. Once this statement is registered with and approved by the SEC, its data and forecasts are placed in a prospectus for potential investors. Any offering of the securities by the issuer or underwriter must thereafter be accompanied by the prospectus. Rule 144. Rule 144, promulgated by the SEC under the 1933 Act, permits, under limited circumstances, the sale of restricted and controlled securities without registration. In addition to restrictions on the minimum length of time for which such securities must be held and the maximum volume permitted to be sold, the issuer must agree to the sale. If certain requirements are met, Form 144 must be filed with the SEC. Often, the issuer requires that a legal opinion be given indicating that the resale complies with the rule. The amount of securities sold during any subsequent 3-month period generally does not exceed any of the following limitations. 1% of the stock outstanding. The average weekly reported volume of trading in the securities on all national securities exchanges for the preceding 4 weeks. The average weekly volume of trading of the securities reported through the Consolidated Transactions Reporting System, NASDAQ. Notice of resale is provided to the SEC if the amount of securities sold in reliance on Rule 144 in any 3-month period exceeds 5,000 shares, or if they have an aggregate sales price in excess of $50,000. After 1 year, Rule 144 allows for the permanent removal of the restriction except as to insiders. In cases of mergers, buyouts, or takeovers, owners of securities who had previously filed Form 144 and still wish to sell restricted and controlled securities must refile Form 144 once the merger, buyout, or takeover has been completed. Regulation S is a safe harbor that defines when an offering of securities is deemed to be executed in another country and therefore not subject to the registration requirement under Section 5 of the 1933 Act. The regulation includes 2 safe harbor provisions, an issuer safe harbor and a resale safe harbor. In each case, the regulation demands that offers and sales of the securities be made outside the United States and that no offering participant, which includes the issuer, the banks assisting with the offer, and their respective affiliates, engage in directed selling efforts. In the case of issuers for whose securities there is substantial U.S. market interest, the regulation also requires that no offers and sales be made to U.S. persons, including U.S. persons physically located outside the United States. Defining the Securities Exchange Act of 1934, the Securities Exchange Act of 1934 is a law governing the secondary trading of securities, financial markets, and their participants. Key points: the Securities Exchange Act of 1934 is a law governing the secondary trading of securities in the United States of America. The Act and related statutes form the basis for the regulation of the financial markets and their participants in the United States. One area subject to 34 Act regulation is the actual securities exchange. The New York Stock Exchange, the American Stock Exchange, and regional exchanges like the Cincinnati Stock Exchange, Philadelphia Stock Exchange, and Pacific Stock Exchange. The 34 Act also regulates broker-dealers without a status for trading securities. A telecommunications infrastructure was developed to provide for trading without a physical location. In 1938, the Exchange Act was amended by the Maloney Act, which authorized the formation and registration of national securities associations to supervise the conduct of their members subject to the oversight of the SEC. In the last 30 years, brokers have created 2 additional systems for trading securities. The Alternative Trading System, or ATS, is a quasi-exchange where stocks are commonly purchased and sold through a smaller private network of brokers, dealers, and other market participants. Key terms: NASDAQ, the National Association of Securities Dealers Automated Quotations. This is an electronic stock market. The Securities Exchange Act of 1934. The Securities Exchange Act of 1934, also called the Exchange Act, 34 Act, or Act of 34, is a law governing the secondary trading of securities, including stocks, bonds, and debentures, in the United States of America. It was a sweeping piece of legislation. The Act and related statutes form the basis for the regulation of the financial markets and their participants in the United States. The 1934 Act also established the Securities and Exchange Commission, SEC, the agency primarily responsible for enforcement of United States federal securities law. While the Securities Act is very limited in scope, the Securities Exchange Act, also known as the Exchange Act or 1934 Act, is much broader. It regulates stock exchanges, brokers, dealers, and even private traders. Companies raise billions of dollars by issuing securities in what is known as the primary market. In contrast with the Securities Act of 1933, which regulates these original issues, the Securities Exchange Act of 1934 regulates the secondary trading of those securities between persons often unrelated to the issuer, in most cases through brokers or dealers. Trillions of dollars are made and lost each year through trading in the secondary market. Securities exchanges. One area subject to 34 Act regulation is the actual securities exchange. the physical place where people purchase and sell securities, stocks, bonds, notes of debenture. Some of the well-known exchanges include the New York Stock Exchange, the American Stock Exchange, and regional exchanges like the Cincinnati Stock Exchange, Philadelphia Stock Exchange, and Pacific Stock Exchange. At those places, agents of the exchange or specialists act as middlemen for the competing interests to buy and sell securities. An important function of the specialist is to inject liquidity and price continuity into the market. Given that people come to the exchange to easily acquire securities or to easily dispose of a portfolio of securities, the specialist's role is important to the exchange. Securities associations. The 34 Act also regulates broker-dealers without a status for trading securities. A telecommunications infrastructure was developed and allows for trading without a physical location. Previously, these brokers would find stock prices through newspaper printings and conduct trades verbally by telephone. Today, a digital information network connects these brokers. This system is called NASDAQ, standing for the National Association of Securities Dealers Automated Quotation System. Self-regulatory organizations, SRO. In 1938, the Exchange Act was amended by the Maloney Act, which authorized the formation and registration of national securities associations to supervise the conduct of their members subject to the oversight of the SEC. That amendment led to the creation of the National Association of Securities Dealers, Incorporated, the NASD, which is a self-regulatory organization, or SRO. The NASD had primary responsibility for the oversight of brokers and brokerage firms, and later, the NASDAQ stock market. Other trading platforms in the last 30 years, brokers have created 2 additional systems for trading securities. The Alternative Trading System, or ATS, is a quasi-exchange where stocks are commonly purchased and sold through a smaller, private network of brokers, dealers, and other market participants. The ATS is different from exchanges and associations in that the volumes for ATS trades are comparatively low, and the trades tend to be controlled by a small number of brokers or dealers. ATS acts as a niche market, a private pool of liquidity. Reg ATS, an SEC regulation issued in the late 1990s, requires these small markets to 1. Register as a broker with the NASD. 2. Register as an exchange, or 3. Operate as an unregulated ATS, staying under low trading caps. Issuers. While the 33 Act recognizes that timely information about the issuer is vital to effective pricing of securities, the Act's disclosure requirement, the registration statement and prospectus, is a one-time affair. The 34 Act extends this requirement to securities traded in the secondary market. Provided that the company has more than a certain number of shareholders and has a certain amount of assets, 500 shareholders, above $10 million in assets, per Sections 12, 13, and 15 of the Act. The 34 Act requires that issuers regularly file company information with the SEC on certain forms, the annual 10-K filing and the quarterly 10-Q filing. Anti-fraud provisions. The 33 Act contains an anti-fraud provision, Section 17. However, when the 34 Act was enacted, questions remained about the reach of that anti-fraud provision and whether a private right of action, that is, the right of an individual citizen to sue an issuer of stock or related market actor, as opposed to government suits, existed for purchasers. Defining the Sarbanes-Oxley Act, the Sarbanes-Oxley Act is to set new or enhanced standards for all U.S. public company boards, management, and public accounting firms. Key points as a result of SOX. Top management must now individually certify the accuracy of financial information. In addition, penalties for fraudulent financial activity are much more severe. SOX increased the independence of the outside auditors who review the accuracy of corporate financial statements, and increased the oversight role of boards of directors. The bill was enacted as a reaction to a number of major corporate and accounting scandals, including those affecting Enron, Tyco International, Adelphia, Peregrine Systems, and WorldCom. Opponents claim it has reduced America's international competitive edge against foreign financial service providers. Proponents say that SOX has been a godsend for improving the confidence of fund managers and other investors with regard to the veracity of corporate financial statements. Key terms: boards of directors. A board of directors is a body of elected or appointed members who jointly oversee the activities of a company or organization. Off-balance sheet, OBS, or incognito leverage, usually means an asset or debt or financing activity not on the company's balance sheet. Conflicts of interest. A conflict of interest, COI, occurs when an individual or organization is involved in multiple interests, one of which could possibly corrupt the motivation for an act in the other. The Sarbanes-Oxley Act of 2002 is a federal law that set new or enhanced standards for all public company boards, management, and public accounting firms in the United States. It is also known as the Public Company Accounting Reform and Investor Protection Act in the Senate and Corporate and Auditing Accountability and Responsibility Act in the House, and more commonly called Sarbanes-Oxley, SARBOX, or SOX. It is named after sponsors U.S. Senator Paul Sarbanes, DMD, and U.S. Representative Michael G. Oxley, RO. As a result of SOX, top management must now individually certify the accuracy of financial information. In addition, penalties for fraudulent financial activity are much more severe. SOX also increased the independence of the outside auditors who review the accuracy of corporate financial statements, and increased the oversight role of boards of directors. The bill was enacted as a reaction to a number of major corporate and accounting scandals, including those affecting Enron, Tyco International, Adelphia, Peregrine Systems, and WorldCom. These scandals, which cost investors billions of dollars when the share prices of affected companies collapsed, shook public confidence in the nation's securities markets. In response to the perception that stricter financial governance laws are needed, SOX-type laws have been subsequently enacted in Japan, Germany, France, Italy, Australia, India, South Africa, and Turkey. Public Company Accounting Oversight Board, PCAOB. Title I provides independent oversight of public accounting firms providing audit services, auditors. It also creates a central oversight board tasked with registering auditors, defining the specific processes and procedures for compliance audits, inspecting and policing conduct and quality control, and enforcing compliance with the specific mandates of SOX. Auditor Independence Title II consists of 9 sections and establishes standards for external auditor independence to limit conflicts of interest. It also addresses new auditor approval requirements, audit partner rotation, and auditor reporting requirements. It restricts auditing companies from providing non-audit services, EG consulting, for the same clients. Corporate Responsibility Title II consists of 8 sections and mandates that senior executives take individual responsibility for the accuracy and completeness of corporate financial reports. It enumerates specific limits on the behaviors of corporate officers and describes specific forfeitures of benefits and civil penalties for non-compliance. Enhanced Financial Disclosures Title IV describes enhanced reporting requirements for financial transactions, including off-balance sheet transactions, pro forma figures, and stock transactions of corporate officers. It requires internal controls for assuring the accuracy of financial reports and disclosures, and mandates both audits and reports on those controls. Analyst Conflicts of Interest Title V consists of only 1 section, which includes measures designed to help restore investor confidence in the reporting of securities analysts. It defines the codes of conduct for securities analysts and requires disclosure of knowable conflicts of interest. Commission Resources and Authority Title VI defines practices to restore investor confidence in securities analysts. It also defines the SEC's authority to censure or bar securities professionals from practice and defines conditions under which a person can be barred from practicing as a broker, advisor, or dealer. Studies and Reports Title VII consists of 5 sections and requires the Comptroller General and the SEC to perform various studies and report their findings. Corporate and Criminal Fraud Accountability Title VI describes specific criminal penalties for manipulation, destruction or alteration of financial records or other interference with investigations, while providing certain protections for whistleblowers. White-Collar Crime Penalty Enhancement Title EX increases the criminal penalties associated with white-collar crimes and conspiracies. It recommends stronger sentencing guidelines and specifically adds failure to certify corporate financial reports as a criminal offense. Corporate Tax Returns Title X consists of 1 section Section 1001 states that the chief executive officer should sign the company tax return. Corporate Fraud Accountability Title XI consists of 7 sections. Section 1101 recommends a name for this title as Corporate Fraud Accountability Act of 2002. It identifies corporate fraud and records tampering as criminal offenses and joins those offenses to specific penalties. It also revises sentencing guidelines and strengthens their penalties. This enables the SEC to resort to temporarily freezing transactions or payments that have been deemed large or unusual. Debate continues over the perceived benefits and costs of SOX. Opponents of the bill claim it has reduced America's international competitive edge against foreign financial service providers, saying SOX has introduced an overly complex regulatory environment into U.S. financial markets. Proponents of the measure say that SOX has been a godsend for improving the confidence of fund managers and other investors with regard to the veracity of corporate financial statements. What is the Insider Trading Act of 1988? The Insider Trading Act of 1988 amended the Securities Exchange Act of 1934 by expanding the Securities and Exchange Commission's (SEC) scope to enforce insider trading laws. Is the Insider Trading Act of 1988 amended the Securities Exchange Act of 1934 by expanding the Securities and Exchange Commission's (SEC) scope to enforce insider trading laws. The Insider Trading Act was signed into law on November 19, 1988, by then-President Ronald Reagan and essentially increased the liability penalties to all involved parties to insider trading. Since the passage of the Inside Trading Act of 1988, there have been many cases of insider trading, perhaps none more famous than Martha Stewart and the 2001 Imclone case. Understanding the Insider Trading Act of 1988, the Insider Trading Act was signed into law on November 19, 1988, by then-President Ronald Reagan and essentially increased the liability penalties to all involved parties to insider trading. Its full name was the Insider Trading and Securities Fraud Enforcement Act of 1988, ITSFEA. This act came into being due to the increase in high-profile insider trading cases, as well as the increase in monetary values of the trades. People who illegally disseminate inside information leading to an insider trade may also be imprisoned and fined. The act allows the SEC to impose stiff monetary penalties, usually in multiples of the profit generated from insider trades, and the guilty parties may serve significant jail time, up to 10 years, according to the extent of their crime. The actual maximum of the fines imposed was capped at either 300% of the amount of money made on the trades or $1 million, whichever amount was larger. Since 1988, there have been many notable cases of insider trading. In 2003, the Securities and Exchange Commission, SEC, charged Martha Stewart with obstruction of justice and insider trading for her part in the 2001 Imclone case. Stewart ended up serving 5 months in a federal corrections facility. In September 2017, former Amazon financial analyst Brett Kennedy was charged with insider trading. In exchange for $10,000, Kennedy allegedly gave a friend information about Amazon's 2015 first-quarter earnings before the earnings report was released. The history of insider trading occurs when members outside of an establishment are given information that is not available to the public as a whole, and use it to increase their wealth through buying or selling stock. It tends to occur when an unexpected event occurs that significantly impacts a company's value. Insiders may be accountants, lawyers, stockholders, or anyone who possesses private information related to a company's stock price. While it is not illegal to possess such information, it is illegal to disseminate it or trade on it. Additionally, some insider trading is not against the law and happens regularly. In 1914, the New York Stock Exchange responded to Goodrich Rubber's failure to disclose important information regarding a dividend by requiring companies to promptly report actions relating to dividends and interest. 20 years later, the Securities Exchange Act of 1934 significantly advanced laws surrounding the disclosure of transactions of company stock. Thanks to that act, directors and major owners of stock are required to disclose their stakes, transactions, and change of ownership. SEC charges CEO and close friend with insider trading ahead of company sale. The Securities and Exchange Commission today announced insider trading charges against the then CEO and a close friend. He provided with confidential details about his New Jersey-based company's non-public merger discussions that enabled the friend to make $164,260 in trading profits after it was sold to a private equity firm. The SEC alleges that William E. Redmond Jr. frequently dined at a Manhattan restaurant managed by Stefano Signorestri, with whom he eventually became good friends and discussed personal matters as well as his work at Gentek Incorporated, an engineering and chemical company where he served on the board of directors in addition to being CEO. Gentek's non-public negotiations to find suitors for a company sale were among the topics that Redmond shared with Signorestri. Redmond's frequent disclosures of confidential corporate information to Signorestri violated his fiduciary duty and other duties of trust and confidence that he owed to Gentek. According to the SEC's complaint filed in federal court in Manhattan, Signorestri first purchased Gentek stock while in possession of material non-public information obtained from Redmond as the company began various negotiations, and a year later he purchased additional Gentek stock as the company began negotiating in earnest with American Securities LLC. 2 business days after Signorestri's last stock purchase, Gentek announced it would be acquired by American Securities in a tender offer, and its stock price shot up by nearly 40% on the news. Signorestri then tendered all of his Gentek shares to obtain his illicit profits. Redmond and Signorestri, who each live in New York City, agreed to pay more than $324,000 to settle the SEC's charges. Redmond repeatedly shared confidential information with Signorestri that other Gentek shareholders did not have the benefit of knowing, said Andrew M. Calamari, director of the SEC's New York regional office. Corporate officers and directors owe a fiduciary duty to their shareholders to not only refrain from using non-public information to profit personally in their own trading, but they also must safeguard that information so friends and others don't illegally trade on it either. According to the SEC's complaint, Gentek stock also was purchased while in possession of confidential information from Redmond by a waiter at the restaurant managed by Signorestri and the manager of another restaurant where Redmond held a meeting with American Securities representatives. The waiter and the other manager similarly tendered their Gentek shares after the announcement about the sale for $6,162 in combined profits. In the settlement, which is subject to court approval, Redmond agreed to pay disgorgement of $149,139, representing the illicit profits of these 2 traders and most of the trading profits made by Signorestri, who agreed to disgorgement of the remaining $21,283 of his profits. Redmond also agreed to pay prejudgment interest of $26,052 and a penalty of $64,821 for a total of $240,012. Signorestri agreed to pay prejudgment interest of $3,717 and a penalty of $59,609 for a total of $84,609. Redmond additionally agreed to be barred from acting as an officer or director of a public company for 5 years. Redmond and Signorestri neither admit nor deny the charges in the SEC's complaint that they violated the anti-fraud and tender offer provisions of the federal securities laws. The SEC's investigation has been conducted by Justin P. Smith and George N. Stepaniuk of the New York office with assistance from Alexander Vasilescu. The case has been supervised by Sanjay Wadhwa.